You've got a card in your wallet that says no annual fee, no monthly charge, no cost to hold it. Maybe it even pays you. Cash back, points, air miles. So here's a question worth sitting with. If the card is free, and it pays you to use it, then how is it one of the most profitable products in all of finance? Because free for you is not the same as free. This video maps the machine behind the card in your pocket, not which card to get, not how to earn more points, just how the system actually makes money, and who ends up paying for it. This is educational content, not financial, investment, tax, or legal advice. We're explaining how the system works, not telling you what to do with your money. Let's start with what you can see. When you use a credit card, you see a price, you tap, and you're done. If you pay your balance in full, you might pay the bank nothing at all. That's the surface. And if you only look at the surface, one myth sticks. If I pay in full and there's no annual fee, the bank makes nothing from me. It's not true. And to see why, you have to follow the money to a fee you never see on your statement. Engine 1, Interchange, better known as the swipe fee. Every time you pay with a credit card, the merchant pays a small percentage of the sale to the bank that issued your card. It moves quietly through the plumbing, from the store's bank, across the card network, to your bank. In 2024, the average swipe fee on a Visa or MasterCard credit card was about 2.35% of the purchase, up from 2.26% the year before and about 2% back in 2010. On a $100 purchase, that's roughly $2.35 the merchant pays. Just for accepting the card, this is a simplified illustration, not a quote from any specific store or bank. It sounds tiny. It isn't. Added across the whole economy, and according to the Nielsen report, swipe fees on all credit cards came to about $148.5 billion in 2024. That's up from $136 billion the year before. Now, where does most of that swipe fee go? A large share funds the rewards, your cash back, your points, your miles. They aren't a gift from the bank. They're substantially paid for by the swipe fee the merchant hands over on every transaction. Hold that thought. It's the key to the twist at the end. Engine 2, Interest. This is the profit core. If you carry a balance, if you don't pay the full amount each month, the bank charges interest, and on a credit card, that rate is high. Carry a $1,000 balance at around 22% for a year, and you're looking at roughly $220 in interest, before the finer details of compounding. Again, illustrative. Real rates and grace periods vary. According to the Federal Reserve, the interest banks earn on those revolving balances is the single biggest driver of credit card profitability, not the annual fee, not the swipe fee alone. The interest paid by people who carry debt month to month, which means the system quietly sorts customers into two groups: people who pay in full and mostly generate swipe fee revenue, and people who revolve a balance, who become the profit center. The card is the same. The economics are completely different. Engine 3, Penalty fees. Smaller but revealing. The most common is the late fee. Miss a payment date, and a charge lands on your account. In 2024, issuers in the largest reporting group charged about $17 billion in late fees, up 17% from 2 years earlier, according to the Consumer Financial Protection Bureau. And here's the part the system doesn't advertise. Late fees fall hardest on the people least able to absorb them: cardholders with lower credit scores and households in lower-income neighborhoods. In 2024, a federal rule tried to cap the typical late fee at $8, down from around $30. But in early 2025, a court vacated that rule. So as of 2025, the higher late fee regime is still in place. So let's come back to that thought we were holding. Rewards are funded largely by swipe fees. Swipe fees are paid by merchants. But merchants almost never charge you a different price for cash versus card. They set one shelf price and bake the cost of accepting cards into it. which means the cost of your rewards doesn't vanish. It's spread into the prices everyone pays, including people who don't use a rewards card at all. Economists who've studied this, including work published through the National Bureau of Economic Research, describe it as a transfer. People who pay with cash or with a basic no-reward card help pay for the points earned by people with premium rewards cards. And because premium card holders tend to be higher income, the transfer tends to run from lower income to higher income. That's the hidden architecture. The free card isn't free. It's paid for, just not always by the person holding it. So, to map it simply, Engine 1, Interchange. The swipe fee merchants pay on every card purchase, averaging about 2.35% in 2024, and largely funding rewards. Engine 2, Interest. The profit core, paid by people who carry a balance, and the single largest driver of card profitability. Engine 3, Penalty fees. Like the $17 billion in late fees charged in 2024, falling hardest on the most vulnerable. And the twist, because card costs are baked into shelf prices, the rewards you earn are subsidized by everyone, often flowing from those with less to those with more. None of this makes the card good or bad. It's infrastructure. The point isn't to tell you what to do. It's to let you see the machine clearly, so the next time a card says free, you know exactly which parts of the system are quietly paying for it. If this was useful, the next videos keep mapping the systems most people use but few can draw. Subscribe if you want the map, not the hype. This was educational content only, not financial, investment, tax, or legal advice. Nothing here is a recommendation to open, close, apply for, or cancel any product. Your decisions are your own.